Welcome. Look, we all know ESG isn't just some box-ticking exercise anymore, especially not for public stocks. But we're going to go way beyond the basics in this explainer. We're diving deep into the sophisticated real-world ways you can apply ESG analysis across the entire investment landscape.
Okay, so you've probably got a pretty good handle on ESG for equities. That's great, but honestly, that's just the starting line. The real challenge, and let's be real, where the actual alpha is hiding, is figuring out how to translate those principles to other asset classes. I mean, how do you apply this stuff rigorously to bonds or to private equity and real estate? The data's different, the risks are totally different, and your ability to influence things, it's a whole new ballgame. And that's exactly the puzzle we're going to piece together today.
So here's a quick look at our game plan. First, we'll get into why your equity playbook just won't work everywhere else. Then we'll break down the specific needs of fixed income and the big opportunities in private markets. And don't worry, we're going to bring it all to life with some really cool case studies before we wrap up with the one thing that underpins everything, the data.
All right, let's jump right into Section 1, the big challenge. You know that ESG toolkit you've spent so long perfecting for public companies? Well, it's just not built for the rest of the market. To really make ESG work in other asset classes, you've got to totally shift your perspective. And that starts with how you even think about risk.
And this right here really crystallizes that shift in mindset. When you're looking at equities, you're an optimist, right? You're hunting for growth, for upside potential. But with fixed income, you've got to be a pessimist. It's all about playing defense, protecting that principle. The core question completely flips from what's the growth story to am I going to get my money back? And that right there is why a one-size-fits-all ESG approach just fails. The risks that could stop a company from making its coupon payments are worlds away from the risks that might just cap its growth.
Okay, so we've got that defensive mindset locked in. Now let's apply it directly to the world of fixed income. We're moving on to Section 2. See, in this space, ESG has nothing to do with finding the next 10-bagger. It's all about underwriting that core promise of repayment. It's about creditworthiness, plain and simple. So what does that actually look like in practice? Well, for starters, your issuer universe just explodes. You're not just looking at corporations anymore. You've got to analyze sovereigns, municipalities, all sorts of special purpose entities. And your focus has to narrow right down to pure downside risk. You're asking questions like, could this labor dispute or that new environmental reg threaten their ability to pay me back? And this is so important. The maturity of the bond changes everything. I mean, the ESG risks you care about for a 30-year bond are completely different from what matters for a 2-year note. All right, let's pivot. If fixed income is all about playing defense, private markets are all about going on offense. It's about taking control. We're moving into a totally different environment now, away from the limits of public data and into a space where you, the investor, can actually shape ESG outcomes.
And this is the absolute key idea. You're not just one of thousands of shareholders anymore. In the private markets, you've got a seat at the table. You have real influence. You have actual control.
And believe me, that control is a game changer. You're not just sitting back and reacting to whatever a company decides to disclose. No, you can mandate the specific data you need to see. You can build strong ESG KPIs right into the business strategy from day one. And you get to use super specialized frameworks like GRESB for real estate or the BVCA's guide for private equity to drive real, measurable value.
And this matters most when you look at the G for governance. Just think about the IPOs for Uber and WeWork. They were night and day, right? Both had some question marks, sure, but WeWork's messy governance and all the insider dealings, it created a massive crisis of confidence that just completely torpedoed its IPO. It's such a powerful reminder that governance issues you might get away with in private can become absolute deal breakers when you step into the public spotlight.
Okay, so enough with theory. Theory is great, but execution is what really counts. So let's get into some practical case studies and see how pros are actually putting these frameworks to work in the real world.
So here's a great example of a classic fundamental approach. Picture this. An analyst is looking at a chemical company. They see the headwinds coming from new regulations on plastics, but they also see the tailwinds from an aging population that's going to need more health products. And they don't just write a fluffy note about it. No, they translate that insight directly into their financial model. They're actually adjusting revenue forecasts, changing their CapEx assumptions, and using all of that to decide, hey, does this company deserve to treat at a premium or a discount?
Now, on the flip side, you've got the quantitative systematic approach. This is completely different. The goal here isn't to do a deep dive on a single company. It's all about getting systematic exposure across thousands of them. These strategies use third-party ESG scores to just efficiently screen the entire market and tilt a portfolio towards, say, companies with great environmental records. It's all about doing it at scale.
Now, this case study is a fantastic look at what sophisticated integration really means. The team didn't just tweak the discount rate a little bit, which, let's be honest, is a pretty blunt tool. Instead, they built out explicit scenarios right into their DCF model. They asked, okay, what happens to our sales projections if this company's social impact helps it win more government contracts? Or what's the hit to our margins if this data privacy risk actually becomes a reality? It's so much more precise and, frankly, a much smarter way to do it.
Okay, let's circle back to fixed income for a minute. In this example, you have a credit team that built their own proprietary ESG score. And this wasn't just some extra data point on the side. It was a primary input, right there alongside traditional metrics like leverage and interest coverage. So when they looked at a consumer goods company, they were laser-focused, asking questions like, could their weak supply chain code of conduct create a scandal that hurts cash flow and ultimately threatens their ability to pay back their debt?
You know, every single one of those case studies, whether it was fundamental or quantitative, was built on one thing: data. So for our last section, it just makes sense to look at the data itself, the whole information landscape that's fueling every single ESG decision.
And it's so important to get this distinction right. Think of it this way. Primary data is the raw ingredient, straight from the company, their sustainability reports, their disclosures. Secondary data is the finished meal. It's that raw data after a third party has cooked it up, scored it, and rated it. Look, one isn't necessarily better than the other, but you absolutely have to know where your data is coming from and what biases might be baked in. That's just fundamental.
A perfect example of this secondary data in action? Morningstar's sustainability ratings, those little globes you see on fund reports. What they do is brilliant. They take the ESG data from every single stock inside a mutual fund, roll it all up, and give you one simple rating for the whole portfolio. It's a super powerful way to get a quick snapshot of a fund's ESG profile.
And that really brings us to our final question, the big takeaway here. As ESG data gets easier and easier to find, as it basically becomes a commodity that everyone has access to, what's going to be the real competitive edge? I'll leave you with this thought. Maybe the edge won't come from just having the data anymore. Maybe the last true edge will be in the sophisticated, tailored, asset-specific analysis that turns all that raw data into real, actionable insight. Definitely something to think about.